So the Inflation Reduction Act was just passed yesterday. And what does that mean for real estate investors like yourself? Well, it could mean a lot. I'm going to break this all down in just 1 second. But if you like this video, make sure to hit that like button to help get the video into the hands of more real estate investors and help them become tax smart. Also, while you're there, don't forget to subscribe, hit the bell icon so you don't miss out on future releases. And last but not least, check out some of the links we have in the description. We have a link to our free Facebook group where dozens of conversations are taking place on how you can reduce your taxes with other real estate investors. Additionally, we also have our Tax Smart newsletter where we release tax tips on how you can reduce your taxes on a weekly basis. So go ahead and check those out. But with that being said, let me dive right in here. So again, I'm recording this. I want to get this information out to everybody. So please excuse any non-edits. This is kind of just going to go right to YouTube. And if I'm not looking at my screen, I'm looking down. It's because I'm reading off of my paper that I have here regarding this act. And this was a 730-page act, and there's going to be 430 billion in government spending in total. But I'm just going to break down the 2 or 3 key items for real estate investors to understand, because that's why we're all here, right? All right. So first things first, carried interest did not get touched. So there's a lot of talk about eliminating or extending the requirements of carried interest to make it harder to actually benefit from. So let me just pause here real quick and explain carried interest. So for anybody who does not know what carried interest is, carried interest is the way that real estate syndicators and funds and private equity and hedge fund managers are compensated. So rather than just taking money in the form of taking compensation in the form of salaries or fees, they usually get a percentage of the deal, which is known as a profits interest or a carried interest. So for example, let's say that I'm going to go buy a 200 unit apartment complex and I'm going to be the general partner, meaning I'm putting the deal together. I'm raising the money. I'm making everything go, right? Well, I might take a 20 or 30% interest in that deal for my efforts. So rather than getting paid just in fees or again, salary, what's going to happen is the investors are actually going to allow me to take 30% of the actual equity in the deal as a result to be compensated for it. Now, when this happens, I'm technically working for this because remember, as a syndicator or as a fund manager, you actually have to make the deal go. You have to raise the money. You have to put the property under contract. You have to find the property, right? You have to do all of this work to not only acquire it, but then manage it, add value to it, and ultimately dispose of it. So there's a lot of work that goes involved in it. And usually this is considered earned income, right? Like you're working for it. And when you get, and normally when you're working for this, you should be getting taxed at your ordinary income tax rates, which, as we know, go up to 37% at the highest end of the federal bracket. However, for the carried interest, you're generally taxed at the capital gains rates, which are much lower, right? The capital gains rates go up to a maximum of 20%. It's a lot lower. That's about 17% lower than 37%, right? So there's a lot of controversy around the carried interest rules because people think that, okay, if a fund manager or a syndicator is going to go and add a lot of value through their own efforts through working, basically, then this should be considered earned income like other businesses, right? Like think about it. If you're a real estate agent and you go close a deal and you earn a commission, you're getting taxed at what's happening is you're getting taxed at your ordinary income tax rates, right? Whereas this person who is the GP of a syndicate is getting taxed at 20%, despite the fact that it's still really earned income. So anyway, there's a lot of controversy around this favorable tax treatment that syndicators and fund managers get. And they wanted to close it or they wanted to maybe extend it out right now in order to get the favorable tax. Right now, if you have a carried interest, right? Again, a carried interest is a percentage of a deal for you making it happen and running the deal. If you have carried interest right now, to get that favorable capital gains treatment at the long-term capital gains rate, you have to hold it for at least 3 years. However, they wanted to extend that out to 5 years. That was in talks, and there's other talks about eliminating it. But the good news is carried interest did not get touched. So that's good news for all the syndicators and real estate fund managers that are out there listening to this. Looks like you are saved, at least for now. Now, something that's going to probably impact a lot more investors is the fact that the IRS is doubling in size. All right. So the IRS is going to receive nearly 80 billion in new funding over the next 10 years. And when you adjust that for inflation, that's more than 50% of the agency's annual budget. That's a huge increase. And they're expected to hire 87,000 new agents. It's 87,000 right now. The entire IRS force is 78,000, right? So 78,000 people currently employed by the IRS. Now they want to add an additional 87,000. That's more than doubling their workforce. So they're staffing up bigly. And it's expected to increase their capacity by an additional 1.2 million audits. And what that means is there's going to be a lot more people getting pulled for audits. Okay. And there's a lot of speculation and rumors on who they're going to be targeting and who they're not going to be targeting. But let's just say it like this, right? There's going to be 1.2 million new audits. You could expect, anybody, and you could reasonably expect that they're going to start targeting small business owners and the middle class, right? They already have teams of people who are going after the wealthy, and then the wealthy have teams of attorneys and CPAs and what have you that fight back, right? So it's not an easy win for the IRS to go after the wealthy, and they've already been doing that, right? So who are they going to target? They're going to target the low-hanging fruit. At least that's what's expected at this point. And what that means is that you need to get it. What that means for you as a real estate investor is you want to get your records in order now. And that's because audit defense starts before the audit, right? So if you're using tax positions like the real estate professional status or the short-term rental loophole, what you're going to want to do, okay, what you're going to want to do is you're going to want to start documenting your positions today. So that means getting your time logs in order, making sure that you have that you can substantiate the time that others spent on the activity if you're going to be using the 100-hour test, right? You're going to want to make sure that you have your records if you're using the short-term rental loophole and you're having an average stay of 7 days or less. You want to be able to document that, right? So you want to be able to document these positions. If you're not sure what to document, have that conversation with your CPA or tax advisor now, so you can start putting that together now and be prepared for an audit. Because I can tell you, it's a lot easier to defend an audit when you have everything nice and neat and ready to go, rather than getting the audit and having to scramble to put everything together. And you got to remember, audits don't happen right away. Audits can take years before they manifest. So you might be audited for 2022 in year 2025, right? And that's 3 years ago. It's a lot of stuff you have to go back and put together 3 years ago. And it's just not, it's going to get messy. So our recommendation would be start documenting the stuff now, because you never know what's going to happen or who's going to be really targeted for these audits. Okay. The second thing, getting your bookkeeping system in order, getting your accounting system in order, right? One of the other ways the IRS could attack during an audit is they could come in and say, you know what, we want to look into these deductions or these expenses on your Schedule E or Schedule C, depending on what type of business you have, right? Or perhaps on your partner or S corp returns, right? So you want to have a good bookkeeping system in place that cleanly documents your income and expenses and has receipts as a backup. Because if you keep all the stuff nice and clean, organized, and orderly, when it comes up for an audit and the IRS knocks on your door asking about those expenses, you're going to be able to pull up your bookkeeping system and say, look, here is all of my substantiation. And it makes things a lot easier, and you put yourself in the best position to win. Okay. So I'm not trying to turn this into a big audit scare or anything like that. I'm just letting you know that there's 87,000 new agents coming aboard. There's going to be 1.2 million new audits. There's a lot of speculation on who they're going to be targeting, but it's safe to say that getting your stuff in order today is not the worst thing. Plus, there's a lot of other benefits to having your bookkeeping system in order. Just the ability to file taxes much more easily, and making it a lot more streamlined for everybody involved, you, your accountant, everybody. So that is that's kind of it in a nutshell. Just to summarize here, carried interest, which everybody was scared was going to get touched, did not get touched, which is good news for real estate syndicators and funds. So if you're a general partner or sponsor, that's good news. It's not getting touched, at least for now. Who knows when they'll try to attack it again? I'm sure they will, but they haven't done it now. They haven't succeeded, at least now. And the biggest takeaway for real estate investors, again, is the IRS is doubling in size, going to bring 1.2 million new audits to the table. And all that means is you want to start preparing for an audit now. It doesn't mean you should take a step back and not take the strong tax positions that the tax code allows you to do, like the short-term rental loophole or real estate professional status. Doesn't mean you should run and hide. It just means you should prepare for an audit and keep yourself nice and organized. That's about it. So again, thank you for tuning into this video on the Inflation Adjustment Act. And again, if you like this video, go ahead and hit that like button. If you want to see future tax smart videos, go ahead and subscribe, hit the bell icon so you don't miss out anymore. And if you have questions, comments, or concerns about the Inflation Adjustment Act, or you want to leave some comments in the comment section about what other videos that we should be making that might be helpful to you and your business, please go ahead and drop them in the comments below. We'd love to hear from you.